Hello, YouTube. Welcome back to the Wealth Catchers channel. Thank you guys for tapping in with us. So we have the weekly market recap. We're going to go over what happened last week from December 8th, 2012. And again, this is not financial advice, just primarily for educational purposes only. Do appreciate you guys coming in, and feel free to like, comment, subscribe if you find this information valuable to you. If you'd like to see more of it, also feel free to leave any comments in the bottom. Any ideas for videos you want me to go over or come up with would be greatly appreciated. All right, let's dive into it. So we have the performance of the indexes. So we have the Dow Jones was up 1.1%, ended up hitting an all-time high on that. S&P 500 did end the week negative after rallying a bit. It was about 17 points away from hitting a new high, or at least getting to the previous high. So it was actually pretty surprising that we gave that much back. In the Nasdaq, big sell off in that, 1.5% down. Saw a lot of names like tech getting sold off, a lot of names in the AI space getting sold off. And then we did have the Russell 2000 had a nice rally. So the small caps definitely took off, definitely outshined a bit in that group. And then obviously we know why. We're going to dive into that next. It definitely had to do a lot with the Fed cutting rates. So put this week in context. So the Fed did come through with a decision that we all pretty much figured was going to happen. They did a 25 basis point cut. So just a 0.25% cut. And that's what did start the rally kind of in the middle of the week. But then towards the end of the week, everything kind of tapered off, especially Friday. A lot of things sold off there, right? So why the volatility? So Fed policy expectation that's already pretty priced in. You can look at prediction markets. You can look at the Fed watch tool. So a lot of this was already kind of baked in, high probability that this was going to happen. So yeah, we did get some push for it, but again, good amount of it's baked in. So you gotta understand how we look at the markets, they're forward-looking mechanisms. So it's always kind of seeing like, hey, what's the next catalyst? What's most likely going to happen, right? And that's what's usually getting baked into the prices of things, right? And then another reason, the AI, right? AI growth, AI and growth stock valuation sensitivity, right? So still the speculation about the AI bubble. Hey, are these things overvalued? Can this really, work out in the end? So obviously that fear is still around. So that also led to some selling off. And then there's been some kind of misunderstanding a bit about what the Fed is actually doing during this rate cut cycle. So now we have our third rate cut, but also some of the commentary they had made. So we just want to go ahead and dive a little deeper into it to clear it up. And then also during this voting period, we saw the most dissenting votes since 2019. So it kind of puts a little highlight on some internal disagreement about, what's the best path to take. We have some folks that, I think I mentioned this before, that want to keep cutting rates. Some of them think we're not cutting aggressive enough. They want half basis point cut. Some believe we should just keep it right where it's at. And some others thinking that, what are we even talking about right here? Maybe I don't know. I ain't read into it. I don't know if they saw anything that said about anyone wanting to hike, but a lot of it is keep it where it's at, or I want it to be more aggressive, right? So that we see some um, internal issues at the Fed with that in terms of like what is really wanted, right? But in the end, the rate cut for the 25 point basis actually did go through. So, and then some forward commentary on that. I think they had said that we're looking at potentially one rate cut following for next year and probably the year afterwards. But obviously, Jerome Powell is not going to be there um, to finish off next year. I think he's leaving. I think it's first quarter or second quarter of next year. We're gonna have a new Fed chair, and then to dive more into this. So basically, the Fed's moving towards policy easing, but the liquidity support that they're turning on and then tapping into is going to be focused more on short-term stability rather than suppressing long-term rates, right? So this is going to keep yields elevated and put pressure on rate-sensitive assets like tech. So these higher yields are going to be hurting sectors like the tech sector. And then we're going to break that down even further onto the next one. So what does this mean? So the Fed is prioritizing financial system stability, right? Even if it means tolerating some inflation risk. So I don't want to dive into the QT, QE conversation, quantitative tightening, quantitative easing, you know, but a lot of people do kind of feel like this is quantitative easing, right? Like money's getting injected, and money is getting injected, but it's not in the way we're used to. It's not like the 2020 pandemic or the 2008 crisis. This money is primarily like liquidity management. So it's kind of helping these banks being able to stabilize them over the short term, sorry. So what we're seeing is governments are struggling to sell long-term bonds across, the globe, and it's forcing greater reliance on short-term borrowing. So a lot of people aren't buying these 10-year, 20-year, 30-year bonds. So if people aren't buying them, government can't raise the money they need to or issue the liquidity they need to get the money into the system. So they're going to be relying more on the short term. So things are coming 30 days, 60 days, 90 days due to be able to, fulfill liquidity needs. And short term, it's like putting a band-aid on a situation. Short term might probably work out, but they can't rely on that for too long, right? So doing that in the short term, this could potentially be what the long-term hope or the long-term bet is, right? Policymakers are betting that productivity growth from AI, infrastructure, and innovation can outpace debt and stabilize the system. So basically, it's hopes for a productivity boom, right? Because we keep hearing all this talk and the speculation about how AI is going to make more things more efficient, how it's going to help things be more productive. We're still waiting for that to pay off, right? And it seems like here, instead of just going about traditional QE, how we used to do it, or what we're accustomed to, is more so let's see what we can do in the near term and then see how this plays off for us, right? That's kind of what it's being viewed as and what's kind of like on the table at the moment. So, again, back to the AI bubble, AI speculation. I understand it from the point of you're probably looking at the chips, these backlogs of orders, and these promises that need to come through, right? And we're going to dive deeper into it later in the video about the picks and shovels that I mentioned before in the past is like where the real money is at, right? Because a data center being built up, that's real. Money was really spent on that to go ahead and put that cement in the ground, put the wires, this and that, and get those walls up and all that. A company really got paid to do that, right? So that's where I'm going to try to explain it and also show how we could pivot towards, basically AI adjacent situations, things where it's like it's not betting on the semiconductors and things of that nature. So that's what happened with the Fed and kind of how we're trying to frame and understand what they're trying to do for the next steps, right? So over the past week, what we had was a great sector rotation. All those names were flooding out of tech. And other names that fell out of favor, we saw financials go up over 2%, materials up over 2%, and industrials over 1%. So obviously for financials, we know that, Fed cutting rates, it's making it better for them to borrow money from one another at a more favorable rate. Materials showing strong demand for construction, and industrials renewed momentum in production, right? So all these things, this is kind of where I was saying where the real money is at. So financials, it's going to be better for them for lending opportunities, things of that nature. But materials, we need materials to build up these data centers, to build up these projects and things of that nature. And industrials, we need the automation from that and production to be able to pump these things out as quick as we can. Now, will it have staying power? That's kind of where the worry is. Again, back to the AI conversation is, will this pay off? But these sectors here kind of throw financials to the side. But the materials and the industrials, again, you need real product, you need real things out there, real stuff you put your hands on, tangible stuff that's building up, right? You can't deny that's what actually is happening. And then some notable winners we had over the week. Excuse me. Some notable winners that we had over the week in terms of like individual stocks. We had Lululemon. They're up 7.9%. They had better than expected results, and they raised their profit forecast. This was important for them too, but I really feel like a lot of it was the rally that the CEO was stepping down. I'm assuming investors were like more than happy that I went down, because if you've been paying attention to the stock, it has not been the best over the past year. They're down about 50%. So at one point in time, Lululemon was like the best thing out. It was like the new kid on the block. It was right up there competing with Nike, and it is for that higher end consumer. But they were just on a great run, and then out of nowhere they just fell apart. So this is some positive in the short term. This is some positive news for them. Very notable that they shot up so much. But again, CEO stepping down, definitely gotta see and wait what happens with that. Who's gonna be the leader for that company over there? But it is something positive for them that they're gonna get someone new, hopefully some fresh blood in there to help get them back on track. But it's definitely a consumer discretionary sector that you can look into. It is risky because it's clothing, it's apparel, things of that nature. So definitely do some research, invest at your own risk, obviously, and make sure you're well informed. Then we got GEV, which is Vernova. So this was a spinoff company of GE. So GE span off some companies. I think it was about a little over a year ago. So this is the energy part that they spun off. And in one day, they had a 15% pop. So positive outlook on AI powered demand. And so far this year, they're up about 100% year to date. So they're doing the gas turbines, and they're just pretty much being viewed as like a big part of putting energy into the system to power AI and things of that nature. So I feel like they're really slept on. Like even me, I wasn't really paying attention to it. On my watches, I got NEE, Next Era Energy, been focusing on that for a while. Been on the watches for a couple of years, but GEV has definitely been a sleeper, definitely at the forefront now. It could be viewed as one of the market leaders in their space, right? Then we got Rivian. Rivian, if you know, they're supposed to be like the competitor to Tesla. They're in the EV space, EV market. So they also had a 15% pop in one day, and those gains came from AI. They come up with their own custom chip, and then some advancements in their autonomy driving. So kind of like their own full self-driving stack that they got going on. So some positive news and advancements in there. It's great for them if you've been paying attention to them. If you've been able to get into it this year, you're up a lot. 40% year to date. It's a great, investment in terms of if you got in at the right time, right price, and you're holding on to now. But if you were one of those ones that got into IPO back in 2021 when it first came to the market, you are down 85% in this name. So keep that in mind. That's when it comes back to the whole we mentioned before in our like fundamentals and our stock 101 on the base level of like getting into the market, be investing, things of that nature. Mentioned chasing. Rivian was one of those hot stocks everyone was going after. Again, IPO just hit the market. Everyone's falling in love with it. Down 85% since 2021. So you've been holding the bag, whoever bought back then, 4 years. You still 85% is crazy. But again, someone who got into it this year, they're sitting pretty now. They got to the point of was capitulation. So when it was at the most desolate spot it could have been at, the most hated it could have been at, people got in, rose it up. Now they up 40%. So if you are going to take those risks, I'm just saying be careful, do your research. And again, I'm a big believer if anything's ever coming to the market and it's saying it's the next this, the next that, just buy whatever it's being compared to. Hey, this is the next Amazon. Let's go buy Amazon. This is the next Tesla. Just go buy Tesla. This is the next Google, next Microsoft. Just go buy Google and Microsoft. Maybe you could put a little position into that company that is being lauded and like, oh my gosh, this is so great. Maybe put a small position into it, but don't put all your eggs in one basket on that. Like something like Rivian, if you thought it was gonna be the next Tesla and you put the house on that, you're down bad, down terribly. But that was definitely a notable winner on the week. But again, long term, definitely not a winner. So got some losers of the week. You might as well just make this whole section here just straight AI because that's basically what it is. So we got Oracle down 14%. A lot of this did stem from a report that came from Bloomberg saying that, like, hey, those data centers and those things that I said they're going to be able to build out the projects they got for OpenAI, it doesn't look like it's going to be 2027. It looks like it's going to be, in 2028. So that caused the stock to spiral, right? And then they came back, Oracle did, saying like, hey, that's not true. But the damage is already done. Once some little bit of news comes out that's not in your favor, it already makes your stock go down, tank it. You could try to save face, but the damage is already done. People have already sold out. People are already betting against it. But a lot of it was earnings report was disappointing, but a big portion of it was that backlog. Like, hey, you have this promise to OpenAI that you could deliver, and then now some leaks and some reports come out saying that you probably can't do what you said you were going to do. And you have these obligations, right? So Oracle is one of those stocks you got to remember. They had a great day when they had the earnings report back in September, and they stock went crazy in terms of like the customers they got, the revenue they have basically that's going to be logged in. But now it seems like to be hurting against them. So since that day, September 10th, they are down 42%. So there's been it's been a rough road for them for the past about what is that? About 3 months. It's been very rough for them. Then we have ABGO, Broadcom, down about 10% this week. And their issue is they're warning that their margins are probably going to be a little bit smaller than expected based on their semiconductors because it's just one of those situations where so Nvidia is the backbone for a lot of people, right? A lot of players in the space, things like that nature. A lot of people going to Nvidia, and then the second tier is AMD. But some of these companies are trying to create their own chips as well, so they don't need to go out spend all that money with Nvidia, AMD, things like that. And they're also trying to produce their own chips in house, right? So AVGO kind of has a situation where they are doing, some AI related semiconductors, but the margin on that is actually going to be kind of hurting them. It's not going to be as productive as they probably thought it would be. So again, that's bringing some more concerns about the AI bubble. But overall, for the year, AVGO is up 55% year to date. You can also probably sprinkle in there maybe some profit taking, from people who have been in position long enough, institutions like, hey, we made enough money on this play, let's trim it down a bit. But definitely the fact that they have those semiconductors that they're creating, the margins on them might be slimmer than expected. We got Nvidia. Nvidia leads all this, so it's going to be obviously that they'll be down a bit, right? So they're down 4%. And just about the AI chip demand and the capital spending, they're up 26% year to date. So still pretty good, still beating the market, but not the Nvidia of old. Having like up 100%, up 80% a year. That definitely is slowing down. Excuse me. That is definitely slowing down for them. So again, concerns around the AI bubble, all this chip demand, all this compute that's trying to be, processed, is it really going to pay off? And all this capex spending, is this really going to pay off, right? Then we got Micron. Now Micron doesn't do um, AI chips and things of that nature, but they are a big player in the memory space. So they had some worries about their upcoming earnings, and then obviously some profit taking going into place. So the fact that they are basically AI adjacent, and they also have some ties into AI, and the fact that they're a big player in the memory space for AI chips and things of that, and these data centers and all that, they're getting plummeted, they're getting hurt too, but they are up 176% year to date. So definitely something to keep an eye out. And then another thing, when you look at this whole tech space, the narrative is very different versus how you look at tech in the past. Tech is always real big on margins. It's like they make so much money. There's so much opportunity to, that extra money having a sideline usually goes to stock buybacks, maybe a special dividend, or, it's going back into the company for research and development, things of that nature. We haven't seen like a spending spree like this from the tech sector in like who knows how long, right? Since that's why they keep bringing back the um the 2000s, the dot com bubble. They keep bringing that up because this tech companies don't normally do this. They don't just go left and right spending money and spending money like it's never going to end. So that's why a lot of worries are coming through because it's like some of these companies are committing to 65 billion a year, 80 billion a year, or 50 billion over the next year or two. It's just like crazy numbers that they're spitting out that they're like, hey, it's earmarked. We're going to spend this over the next year, 2 years, 5 years. And then for investors, that just sounds crazy because they're thinking about it too. Is it worth the risk? And do you really need that much money to go out there to go ahead and try to accomplish this? And if you do put all that money out there, will it pay off? Will it be worth it in the end? Will it return that value that you expected to the shareholders? Because at the end of the day, that's what matters, bringing value to the shareholders. And then we got market sentiment, fear and greed index. We're at a 42 right now, so a little bit of fear, but it's nothing too crazy. Obviously we've seen worse. We've seen 8, we've seen 15, 20, and 10. So we've seen those numbers over the past, like from Liberation Day to even a couple weeks ago. We've seen some lower numbers. Crypto market still in fear. It's at a 27. Obviously went back a little bit. We know that Bitcoin's having a hard time to stay above 90, 95K. It's been pretty much at 90 or lower for a while. And then the technical market overlook. So overview. So I just put the ETF equivalents of the four indices I really care about. So S&P 500, the Nasdaq, Dow Jones, Russell 2000. So you see for the SPY, still above all moving averages. RSI. I don't know if I explained it before in the past video, but RSI is basically an indicator that lets you know if something's oversold or overbought. So usually 70 or above is overbought, 30 or below is oversold. So overbought meaning it's a hot stock right now. A lot of people are buying in. There's a lot of buying into it. Most likely it is probably going to cool down because so much buying at some point is going to get exhausted. Then you have oversold. So many people are dumping the stock. So many people are getting rid of it. At some point, it's going to need to find a bottom, and then people are going to start buying back into it, right? So usually 50 means neutral. So that's when people see, oh, it's 30 or below. I'm going to dive into it, try to hold on to it. RSI gets back to 50. I'm gonna probably try to write it back up to 70, then I'll sell out. But again, whenever stocks do sell off or stocks do run up, always make sure you do your research to know why it has run up or run down. All right, so definitely do that. We have the MACD. MACD is like a momentum indicator, so it just kind of help solidify confirmation about like, okay, why is it running? Which direction it's running to? Like to the upside, to the downside, if it's neutral. So we do see the MACD SPY curving downwards. So this is all on a daily chart. So usually, things over the days they add up and it becomes your weekly. Then it kind of sets the tone, right? So use your shorter time frames to kind of build a bigger picture out for you. So it's curving downwards on the short term. Then you have QQQ. It's at the 50-day SMA. So that's a key buying point or key level for a lot of people too. 50-day SMA. QQQ has fell there now, so that could be an attractive buying spot for some people. Me personally, I like the 100-day SMA, 200, 253, and then the best price, probably the 400-day. So those are my levels I like to look at when stocks fall, or indexes, ETFs, whatever the case may be. Names I like fall to those. Those are some key areas to, have build some positions in tranches. You buy a little bit here, buy a little bit there. RSI for QQQ is 47, so still pretty neutral. The same thing for them. MACD is curving downwards. And we got DIA, which is the Dow Jones. As I mentioned earlier, they hit an all-time high, and it is also above all moving averages. RSI is at 62, and the MACD momentum is to the upside. And then we have the IWM, which is the Russell 2000, also hit a new all-time high and above all moving averages. RSI is at 60 and momentum's to the upside. So from here, you can kind of get a good idea what's going on. You see the SPY and QQQ, both of these, even though the S&P 500, the SPY is supposed to be top 500 companies, diversified across 11 sectors, yada, 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 yada. But we know the leaders in the SPY are mostly tech companies. The top 10 is basically all tech. QQQ, we know it as strictly basically tech. So for both of them to be down, it makes complete sense. And then we have the Dow Jones, which again I mentioned before, stock market fundamental video. Dow Jones is dollar weighted. So basically, the price of the stock within that index is what holds the most weight, right? So if you have something like a United Healthcare or a stock that's $300, $400 within that index is going to be more weighted. It could be a freaking energy stock is worth $400. It's going to have more weight than Amazon, who might be at $200. So that's how the Dow Jones work. It's very backwards in comparison to the other indexes, which are market cap weighted. And then we have Russell 2000, IWM. Again, rate cuts on the horizon, baked in. It's been a trade, if you've been paying attention for the past year, it's been moving slowly upwards because rate cuts and lower interest rates is a higher favorable environment for stocks like this. These are your small cap companies that them having access to capital at a cheaper price is better for them to be able to make investments, be able to invest in the things that they need to that they need to be able to grow and help their company grow and become bigger and more established, right? So that's where you can see the two differences between those two indexes, the Russell and the Dow versus the QQQ and the SP 500. So then we have some forward-looking events. Tuesday, or you can also look at these like catalysts that may be coming up. They could probably affect the market. But obviously, depending on the numbers, depends on how great of a deal. Tuesday, December 16th, we have the non-farm payroll numbers that's going to come out. Then the 16th or the 17th of December, we have the retail sales data that arrives. And then Thursday, December 18th, we have the CPI. And then December the 18th or the 19th, we have Bank of Japan, which we know is probably safe to say that they're going to raise interest rates because that's what we've been doing in the past. So all these things will give us some insight on things like, strength of the labor market, strength of the consumer in terms of spending. CPI is going to let us know where inflation's at for November. And Bank of Japan is going to kind of help solidify, all the stuff's been going around in terms of the global markets, because other central banks are making their cases too for either cutting rates, keeping them steady, or rising. And then Bank of Japan was also one of those that when they raised their rates, it kind of was the yen carry trade, something that happened back earlier in the year. So them raising interest rates kind of caused an issue. It's more baked in now. We know that this has been going on for a while, but it did cause a spur of stocks selling off a great deal. I think it was like earlier in the year. I don't know if it was quarter one or was that last year. But I know when they started raising rates, it started like a whole issue with everything in the market, a lot of fear. So watch list themes, things that we'll watch out for and look out to. I feel like going into the next week and also probably going into 2026. So AI power, to look at the names that are needed to push the AI revolution forward on the foundation level, right? So again, on the ground level, not just the semiconductors. And then for the sectors, we got XLI, XLF, and XLB. So that's your industrials, your financials, and your materials, as we mentioned earlier in the video, the ones who won out this week. Look for them to continue to keep winning. So they're going to have continued strength if the upcoming data supports an economic reacceleration, which is kind of what's being expected, what's being baked in, and what's being counted on, is that the economy is going to start reaccelerating. Economy is going to start expanding in these certain spaces and fields. And then again, small cap momentum. So keep looking for small cap names to keep rolling up. Again, small cap is more and more definitely higher risk versus getting into our large cap names and mega cap names because they're so tiny and we all know what's going to happen with them. They're a very risky bet. So if you are going to try to pursue that, Definitely look into the IWM. That's the basically the face of small cap stocks, but there's other companies that have them, like other brokerages that have, their own small cap versions. But if you are going to make that trade, go in there and looking at and build a position. Small caps is not a bad spot, not a bad thing to have in your portfolio, in my opinion. But obviously, everything has a time and a place. This is definitely a time for small caps. They're definitely going to be winning while we're in a lower interest rate environment. So, what I wanted to dive into was a AI power and infrastructure basket. So, again, get rid of all the semiconductor talk. Just talk picks and shovels, right? Backbone of this whole AI build out. And feel free on this because there's a lot of information on here in terms of names and little things. The percentages on the side is kind of like if you're building your own allocation, right? You don't have to really pay attention to it that much. But the goal for this is for you kind of pick and choose if you want to go the individual stock route, right? And take out semiconductors. What names can I put, you know, tie my dollars to that are going to benefit from AI working out? And also, if it doesn't work out, you're still benefiting because money's going to be spent on these things to try to make AI work out. So the money has to be spent with these companies regardless. If it works out, doesn't work out, these companies are still gonna get their bread. That's what it is. That's what the whole focus is on this, right? So we got power and generation base load. We got things like constellation energy. We know that's nuclear energy, right? So we heard about the power plants, reopening. There's closed power plants they're trying to reopen, bring back online. So constellation energy has been a big part of that. Next era energy, we had them on the watch list for a couple of years. You got Dominion Energy. So all these things are power generation and base load. Next, we got the grid, as we have known and probably heard many, many times. Our power grid is outdated. It's weak, and it probably not even probably. It's damn near guaranteed it can't handle this workload, this build up that we're trying to do. Like it's going to be damn near impossible if we don't make any changes or anything, advancements soon to be able to handle all this workload. That's why you hear these things like we're trying to build data centers underwater, building data centers in space. Like they're testing things out to try to get more compute more efficiently, and we're leaving Earth to try to do it. Like we're in orbit trying to get it done, and we're underwater trying to get it done. So it just highlights like the grid is not strong enough, and that's just the grid in the U.S. We're not even talking about going to other countries, things like that, because this is going to be a global phenomenon. The world's going to be using this. So definitely companies like Eaton, Emerson Electric, they do play a factor in this. And obviously, these are just some names. There's going to be people who are better leaders or, have a better moat for that situation, but these are just names to dive into. Same thing when you do your research, grab this, you can screenshot it, you could go into your AI, go into YouTube, whatever the case may be, do your research, figure out what's going to be the winners in these spaces, build yourself your own little ETF basket. You can have like 4 or 5 names. You use things like, what is it, brokerages like M1 Finance, build your own little basket, put a dollar amount, and it's going to separate it and make an allocation for you, 20% here, 15% here. And then that could be, you can label it just like this, AI power infrastructure basket. Boom. You got that. And then you just put your little money there every week, every month. And then you got your AI play that isn't affected by semiconductors and this and that. They're going to make their money regardless because they're already making money anyways because this is what they do. So AI is just um, what is it? It's a boom to them. That's what it is. AI is just going to help them out in terms of their dollars that they're bringing in, but they're going to make money anyways, right? And then we got data center and infrastructure and cooling. So you got Vertiv for the cooling system. You got Digital Realty. You got Equinix. And then we're going to the next screen. Got some more names. So you got to think about network and data flow. You got water and cooling, environmental systems, and cybersecurity. So we know for networking, AI can't really do anything if data can't move quickly, can't move instantly. You got Arista Networks, ANET, and Cisco. So especially Arista Networks, that's the name I've been hearing about a lot lately. And then you got the water cooling, and environmental systems. So as we know, you've probably seen reports on it for good or for bad. These AI data centers that are being built kind of in the middle of nowhere. You hear these small towns complaining about the water not being the same, or they're not having access to water. That's because these data centers are sucking up so much water. They use so much water to be able to cool their systems down and to be able to run. And then again, these little towns are being kind of overlooked and forgotten about. And then this is where the whole thing is like, the cost of investment. These are real people, real lives, real towns, real cities being affected by this. So, which is kind of even putting more of an onus on, hey, we have to figure this situation out because this isn't sustainable. And the companies that can profit off of this and benefit from being part of the cooling system, being part of the water system is XYL. And then we have Ecolab, which I'm surprised by because I just know Ecolab for the hand sanitizers and things that they're doing during COVID. When you go to the restroom, you see a little pump Ecolab, but they also do have a play in industry cooling and water efficiency. And in cybersecurity, I think that's kind of like a given. Cybersecurity, I feel like is probably overall going to be one of the best winners in this because no matter what it is, we needed cybersecurity 10 years ago, 15 years ago. We're going to need it 20, 30 years from go into the future, regardless of AI works out, doesn't work out. AI, for the most part, is going to work out because it needs to work out because I cannot see a country like us, the US, and countries like China that are putting so much money into this, right? For it to fail. That would be insane. And I think I'm not gonna say it's gonna be too big to fail, but it's gonna be one of those situations where they can't let it fail because there's no going back from that. I mean, you got so much investment on a global scale for it not to work out. Now it's about the patience. Mentioned this I think a while back on one of my first videos. I mentioned it. It's the timetable people are having an issue with and can't wrap their minds around. They want like the immediate returns, the immediate payoff because it's a lot of money and it's a scary amount of money that's being poured into it. And I get it. All you can think about is like, where's the return? Where's the return? But these type of returns is going to take a while for it to play out. Maybe 5 years, 10 years, 15 years down the road, right? So that's the situation that we're looking at. But again, cybersecurity, name I love for a long time, CrowdStrike. Even after that, they shut the world down. I'm still rocking with them, but CrowdStrike. And we also got Palo Alto. We got some other names in the space too. You can look into an ETF like Cyber, crack that open. Two other cybersecurity names are in there, but definitely like CrowdStrike and Palo Alto. I feel like they're the top leaders in that space. They're like household names. And then we got the key risk. So there's some potential hazards that can impact market stability and sentiment that's coming up. So again, we are facing multiple risks. So we got the AI valuation, compression. So a lot of worries about the AI bubble again, the speculation about that. And then I could say, we should be prepared for some volatility, some corrections. Again, view corrections as opportunities to, look at your portfolio, see how you're allocated, use those as opportunities to build positions, things of that nature. If you trust your research, trust what you did, you shouldn't be, I'm down 10%, 20%, and then ready to throw everything to the wall and then just sell out your account. No, it's going to happen. Names are going to pull back. It's part of the game. And then we got to pay attention to, the yield spiking on bonds and then what the messaging from the Fed is going to be over the next, guaranteed over the next few months because we're going to have that transition from Powell's going to be there. I feel like he's going to want to end pretty good, but not too many stains on his shirt. Want to end out definitely that next meet I think is I want to say it's the end of January, and then probably hit us with that one more rate cut, and then hey, we'll see you later. You want to end on a good note. That next Fed chair is coming in. We already know what's going to happen. He's going to be most likely following what Trump says. Trump wants lower interest rates. That guy is going to make sure that hey, I'm going to follow what he says, and he's going to cut rates based on what Trump is going to, try to implement and want. He's been banging the table on this for a long time. And then, but I think leading up to that, based on Fed commentary that might lead to some volatility because Jerome Powell is very strategic in how he speaks, doesn't give too much information right away, so he's very meticulous in how he speaks, and he thinks about what to say before he says it and how it's going to play out and pan out. So if you've been following for a few couple of years, you know that he is really intentional about the message he wants to get across and not to spur the markets or worry them in any type of way. But those are some things to look at. It's going to affect our confidence in the market and decision making for some people. And then bottom line, the rate cuts, again, they're supporting the cyclical sectors, as we talked about, the financials, industrials, and materials. And then we got the rotation going on, as you saw, name money going into those. And then we're seeing that the market's getting some more breadth. So that's good. We're super concentrated, still highly concentrated, but now a lot of that is kind of spanning out, spreading out a bit. So over the long term, that is good. You don't want to have too much concentration on the top names. You want to see all the market going up and participating together. So in this situation, like, and during this phase in this cycle we're in, I could definitely see a lot of more of that happening. So then some things to keep an eye out. Look at your equal weight um, ETFs or indexes. So I think I want to say RSP is the ETF for equal weight index I like to look at. So when it comes to equal weight, that means everything across the board is valued the same in terms of position sizing in the ETF. That means like everything has a 3% allocation or weighted 3% in the ETF, right? So nothing's going to overpower the other. So usually those are good things to look at to see what's going on in terms of like how the rest of the market is doing outside of the Magnificent Seven, Magnificent 10, whatever you want to call them. And then those are just some things to look at for. So thank you guys for bearing with me. A little longer video, about like 40 minutes into it, but definitely do appreciate you guys tapping in. And again, don't let the market shake you out your spot, shake your conviction. Don't dwell too much on the short-term volatility in the day-to-day. Things will work out. You gotta have a long-term horizon. Know what you're buying. Know how you're allocated. Know what your mission is. Stay focused on it, and then it'll all work out. That's it. It's good to stay up top of day-to-day, the week-to-week, see what's going on. But again, long-term horizon. That's how you're gonna win in the end. So don't forget, like, comment, subscribe, leave any comments in the bottom if you got for me. Again, email's right there, thewealthcatcher@yahoo.com. You want to send me a message. And also you go to our website, thewealthcatchers.com. Check out any articles on the homepage. You can check the weekly insights. Again, you can check the monthly updates about the watch list, entry prices, points, commentary or comments about what I see in the chart for that particular stock. And thank you guys. Appreciate y'all tapping in. Appreciate y'all visiting. And we'll see you next time.